Hello everyone, welcome again to another business intelligence session with Blessing. My name is Blessing Atonda, and here we talk about building brands that can grow beyond just a one-man running, building brands that you have envisioned to actually run, brands that can succeed with or without your presence. And last week, the last session, we treated mistakes that business owners make, the major mistakes that business owners make that affect their finances and the overall growth. We treated budgeting, we treated reviewing your financials, we treated impulse spending, and we treated the impact of business plan. So today we would be starting with something that is very, like, it's obvious, but then it is really neglected, and that is tax liability. So most business owners do not factor their tax liabilities. You wait for them to bring a fine or for them to remind you, of which it is not meant to be so. So the first thing is, what are the taxes that you are even liable to pay? As a business owner in the product or service business that is not agriculture or health related, as like pharmacies and medical practitioners, you are not, firstly, you are liable to pay VAT. That's value added tax. You are meant to pay VAT every month from the 6th month of your operation. Like, you even have a 6 months grace, but after that 6 months, you're liable to pay VAT every month. And how you do that is, you have to file your VAT returns on the Tax Promax website, and then from there you'd be provided with your tax liability and all of that stuff. But before you can pay your VAT, how VAT works is, basically you are paying VAT on products that you sold, right? So if you sold 500,000 worth of items, you're meant to pay 7.5% VAT. As at this time of recording, the VAT liability is 7.5%. You're meant to pay 7.5% on all your sales. But we also need to factor the products that you bought. That's your purchased product. So VAT liability is VAT inputs minus VAT output, which is the products that you bought. You have already paid for VAT, like your suppliers have already taxed you, they've already added the VAT to your sales and to your purchase. So you've already paid for VAT, so you have to remove that amount from the amount that you're taxing your customers. For instance, let's say you pay VAT on 500,000 naira worth of items, and you also sold 300,000 worth of items. So you have to remove that 7.5% on the 300,000 minus the 7.5% on the 500,000 that you have already paid. So the difference between input and output is that when you're purchasing your items, you've already paid for this VAT. When you're selling your products, your customers are the one paying for the VAT. So that's why you see that when you go to a restaurant or the mall, you always see a 7.5% there, 7.5% VAT, so which has been added to your cost. So imagine you are now setting your pricing without putting the necessary VAT implications, like VAT liabilities. Factoring them into your costing process is also very important. So neglecting your tax liability, like, first you've treated the VAT, so you need to seek the counsel of a tax consultant. You can always reach out to me, and we would always trash that. So you seek the counsel of a tax consultant, and then you make sure that your taxes are being filed. That's the first one, VAT. The second one is, as a limited liability company, you're liable to pay company income tax. There's company income tax, there's capital gains tax, there's personal income tax, there's payee. So your company income tax is for medium scale business. Like, if you have 100 million or above in turnover, you're liable to pay 30%. And there's always a way, there's a way to compute your tax liability. It's not something that we can treat on YouTube here. It's just best you seek the advice of a tax consultant. So you have to pay your company income tax, your capital gains tax as it relates to you. So you make sure that you seek the counsel regularly with a tax consultant, and it can help you. Then it's also very important to file your annual returns on CAC. So this would help your business still be listed as an active registered business on the website. So it's one of the major things where investors, even customers, use that as a means of checkmating your background, checkmating if you are really viable, if you're safe, if their money is safe with you. So it's always important to keep filing your annual returns on CAC. So for neglecting your tax liability, it's important to seek the counsel of tax consultants that would let you know which tax you are meant to pay, which one it is you're meant to file, because all of these things, they imagine planning, budgeting in an amount as your profit, and then tax officials come and say this part is for the government and you've not planned for it. So it is important that if you're paying VAT, you know how much it is you are meant to pay. If you're paying company income tax, you know how much it is you're meant to pay. If you're paying personal income tax for your personal salary and drawings, you know how much it is you're meant to pay. If you're paying payee for your staff, you know how much it is that you are meant to pay. So seek the counsel of a tax consultant or hire a qualified accountant. So that's the first thing we're treating today. And the second thing we're treating today is not reinvesting profit. So most business owners, they believe that the profit is their share of the business, which is wrong. And here is why. So the business has a life of its own. Like your business has a life of its own. No matter how much stake you have in the business, it has a life of its own. So the business also has to eat its own profit. And this is just what I'm trying to say. That you are making 100,000 in profit does not mean that 100,000 is for you. The business also has to eat more so that it can grow more and then bring more to the table. So if the business is making 100,000 in profit, you can always assign a percentage that is suitable for your kind of business that you would reinvest back into that business to maybe a capital expenditure. So let's say you have 100,000 in profit, you can invest like 40,000 back into operations, making operations more seamless, providing laptops, providing data, providing technology things that can make your business processes faster. You can invest that amount back into your business, and then from there the business has the capacity to also bring more to you. So every amount that is allocated to your net profit, or the whole net profit that you have gotten from your business, is not solely meant for you. It is for the business. The business can only pay you part. So always reinvest your profits, because the major reason why there is profit and then there is reserve. Okay, so this is how it works, the concept of profit and reserves. When you make profits, right, you have two options. If you're not paying dividends, that's if you have shareholders that you're paying dividends. If you're not doing that, the money, the way it is meant to be is that net profit is meant to go into your reserve, right? So it's meant to go into your reserve. But let's say, okay, from that reserve you are paying shareholders, or from that reserve you are also taking drawings like your salary from there. That reserve is not meant to be empty. There has to be something there so that the company can always fall back onto something when it comes to capital expenditure, when it comes to growing the business, when it comes to handling emergency situations. That reserve always has to be accounted for. So your profit is not meant for you 100%. You can only take a part, but make sure that you reinvest back into your business. And the next a mistake that I'll be talking about is ignoring numbers when things are going well. So because you think, profit, you're making profit, because you think, okay, everything is fine, your expenses are, reasonable, your profit is okay, then you ignore the numbers. The purpose of keeping up with numbers, even when things are going well, is so that you have a track record, you have data of how things should be in the best case scenarios, so that when things are not going exactly as planned, you always have a metric to compare it with. You have a metric to compare it with, so that you can know what other efforts, what other steps to take in making sure that things grow, in making sure that things go back to how it used to be. For example, there was a season where, okay, one of your products was selling so much, so you kept track of that. When things are selling so much, you know that, okay, if things are selling so much, then at least I make this amount of money. So that when things are not selling so much, you know how much it is that you should actually get. And it helps you in planning, it helps you in budgeting, it helps you not to bite more than you can chew. Imagine there's a season where things do not go well, and that is the season where you embark on capital expenditures. It is going to affect the business. And most times, the way it affects the business, your business might not recover from it, even if it goes back to the usual boom. Your business might not get out of it as soon as when it even gets back to the usual boom. So that's why it's important that even when things are going well, you track your numbers. What is the sales like? What is the cost like? Am I still maintaining the profit margin? Are my expenses still kept in check? Okay, when I get a revenue in sales, does my operating expense also increase? Because operating expenses are meant to be fixed cost. So if there is a fixed cost that is increasing, like an incremental fixed cost, you need to put that into consideration. Review regularly. So that is the purpose of, record keeping and reviewing your reports, to ensure that when things are going well and when things are not going well, you know the metrics, you have the data, so that those data can now inform your decisions. And the last thing on the list of mistakes that business owners are making is not making provision for miscellaneous. Not making provision, like, the business owners that plan and budget, they are obsessed with planning every cent. While that is good, while that is very commendable, there is a need for planning for miscellaneous. There is a need for planning for making provisions. For instance, let's say you make provisions for debtors. And here's what I mean. So you have debtors, like you sell goods on credit. Out of those people that you sell goods on credit, there would be people that cannot pay you back. Some people that will declare bankruptcy, someone that has declared bankruptcy cannot pay you back their money because they don't have the means to. Some declare bankruptcy, or maybe somebody died, and therefore the process of going to the family members to recover your money is strenuous or something. You need to plan for all of these things. Okay, if I am expecting 500,000, let me plan 100,000 for deficits. Let me plan this amount for emergency. So I have made provision for 100,000 for fuel, but anything can happen. Let me make provision for an extra 10,000 for emergency situations. That way, you have planned for worst case scenario. So even when that worst case scenario happens, you are not caught unawares. You have an idea of what can happen. You have made provision for it, and it helps you in managing your money. Because if you have planned every money to the last cent and you have spent everything, how then will you take up emergency needs? And most times, needs that come as emergency might even be used to improve the quality of your business proceedings, or improve the state of your business. It can be used to grow your business. sometimes those things like there's some opportunities that if you are not prepared to tap into them, you might not get them back. So like I mentioned in the case of having reserves, so let's say you have an opportunity just comes up and you need capital to tap into that opportunity, to leverage that opportunity, but there's nothing in your reserve. You've planned for everything and you've expensed everything, so now you don't have money to tap into that opportunity. What do you do? So it is important to make sure that everything that you are doing is planned. Everything that you are working on, as much as you are planning them, you should also make provisions for unforeseen circumstances. Now, there is a thin line between making provisions for unforeseen circumstances and you yourself making that unforeseen circumstances come into life. Like you because you have made provision for a particular expense, you have budgeted for a particular expense, so you yourself, you are a major factor in making that expense happen, of which on a normal day there is is a 50-50 chance, but you influence the likelihood of that expense happening. For instance, you budgeted 100,000 for fuel, right? And you are meant to so you budgeted 100,000 for fuel and you budgeted an extra 20,000 for extra in worst case scenario the price increased or there's an extra need. So because you have budgeted another 20,000 for fuel, you are now using the fuel anyhow. You are not managing it the way it is meant to be because you feel there's a reserve somewhere. That's another like disadvantage of this thing, but it's you have to condition your mind. The purpose of making provisions for miscellaneous and unexpected needs and expenses is not for you to be a factor in making them happen. It is meant to, it's a provision. If it doesn't happen, it comes as an income to your business, like it adds to your revenue. Like it's because it does not happen, you have more money, like you did not spend it, so at least you still have that money in your account because you made provision for that and it did not happen. But if it later happens, it's an expense, right? But it's not catching you unawares because you have already planned for it. So this would be all for this session. We have listed 8 in total, like 8 mistakes that business owners make that affects their business, and the purpose of this thing is just to make you understand, just give you the insight as to the things that might be affecting your business growth. So it is important that as much as you're watching these videos, you are putting them into practice. And there's also a place of an expert holding your hand. So if there's any mistake from these videos, whether it's budgeting, whether it is impulse spending, whether it is business planning, whether it is tax liability and all of that, if you're having any challenges with this, you can always send a DM and book a clarity session or a consultation session so that we know how to drive your business growth. So till next time, we would be stopping here today. Thank you for watching this far. I sincerely appreciate. While you're still here, kindly like, share and subscribe to this channel. So till we see next time, thank you.